Louise Bedford here, your host of the Talking Trading Show. This is how traders excel. Now, before we get going with today's exciting episode, I wanted to tell you a little bit of a story. Way back when my family were water skiers and all of my sisters could do it. They were all older than me. They were really good. And at the age of 4, I really, really wanted to have a go. So the instructions from my mum were, hang on for dear life. Do not let go. All right, I've got it. I'm hanging on. I've got the handle. I'm hanging on. The boat goes. My skis fall off because my tiny little feet were too small. But did I let go? No. I'm bobbing up and down through the waves behind that boat, practically drowning. They had to stop the boat and still I was hanging on. Yes, I was wearing a life jacket, but that doesn't help when you're going Mach 10 across the water. So let's have a think about how this applies to trading. Yes, we do need to follow the rules. We have to be so sure that we understand the rules and that we are focused on following those rules. However, sometimes we need to know when to break those rules, because if we don't, we might just drown. Now, that is the art part of trading. And to help me with this amazing task of finding out when to keep the rules, when to break the rules, how to follow a trend, how to identify a trend, and how to be the best trader that you can be, I have invited to the show 2 sparkling gentlemen, Mr. Christopher Tate, my business partner, and Jason McIntosh. Jason and Chris, welcome to the show.
Hi, Louise.
Louise, fantastic to be here.
Now, Jason, what are your thoughts about my little story about how I nearly drowned?
Yeah, I was listening to that and I was thinking, gee, she's a rules-based trader and she's been good at following rules from a very early age. And and but then it's interesting. It's also like, when you relate it back to trading, it's about, well, what happens when things go wrong? What's our plan for when things go wrong? Because often people think about, okay, what do I need to do to make things go right? But I've also got to consider what happens when things don't go according to plan. How do I reverse course? How do I cut a situation that's not working? As a 4-year-old, that can be a lot to take on, but with the markets, unexpected things happen. Skis fall off. An unexpected announcement comes out in the market. What do you do? Stuff we can talk about as we go on today.
Completely. And Mr. Christopher Tate, tell people a little bit about your background. You haven't been on the show for a little while, and we've got loads of new listeners.
I was just going to comment on your little water skiing story and say, well, you should get better parents.
Well, too late now.
Well, that's true. We can't reverse engineer that.
Well, let me tell you about Chris's background. Chris Tate is my business partner. He's been trading for many, many years. I think when God put out the blueprint for Chris's mind, they gave Chris 98% on the markets and 2% for the rest of his life, but I'll let you be the judge. Now, Jason McIntosh, you are our regular guest on Talking Trading. So for everybody who has not heard Jason present before, you are in for a treat. Jason is a friend of mine and Chris's, which is just a beautiful thing. But more importantly, he is an exceptional trend trader. A lot of the things that Chris and I do in the markets, Jason, through independent evolution, also has replicated, because there are just a few things that work and there are many, many things that don't. Now, Jason began his career in 1991, which was just a year after I started trading, on the trading floor at Bankers Trust. Now, I used to give money to Bankers Trust and invest in Bankers Trust. So who knows, Jason, you might have invested some of my money. Now, you are the creation of the Motion Trader trading system at motiontrader.com.au. Now, luckily, we have a free course available for all of our Talking Trading listeners through Jason, and that link is motiontrader.com.au/talking Talking Trading. Now, Jason, you are a celebrity in Australia. I am loving dealing with all of the things that you seem to be on. You're on YouTube, you're on AusBiz, you are just everywhere. What are the gaps in your bio that I've left out?
Oh, look, I think you probably covered it quite well, Louise. Look, trading is I started getting an interest in markets when I was probably in around maybe year 9, year 10 at school. So this is going back to 1984, 85, and I didn't have a clue what I needed to know, what I was doing. I was interested in speculative stocks, 1 cent, 2 cent mining companies. Dad had an interest in the market, so I was kind of like coming in on that. And it's interesting when you're starting out, you just don't know what you need to know. And it wasn't until I got out of that speculative phase, like through school into my early years of uni, got into Bankers Trust, that I started to actually learn there's a process to this whole business, and the people with the process are the ones who make the money. The people who were doing what I was doing in my start, where I was getting my interest, when I was getting my interest, it was all about, look, can this stock double? What's my upside? So it was all very upside focused, and you got to have an upside focus, but I didn't have the risk management side. I think that's something we can probably go into greater depth later on. So yeah, look, that's how it started, but it's one of those fascinating areas, the markets, that you can take through from being at school right through your career into retirement. It's one of those things we can continue doing. Like, people were talking through COVID about like how they were watching Netflix all day. It's like, well, I've got an interest in the market, so like, of course, I do other things other than just look at the markets. But it can be quite an absorbing thing, where it's not a job to look at a stock chart, but it's an interesting thing to see all the stocks, see all the signals, see all the movement, look at the opportunities and the setups. There's a whole, literally a world of things to take on board.
So tell us a bit more about your approach to trend trading.
Well, trends are fascinating. So you can pull out any chart and you're going to spot trends. So they could be big trends, small trends, all the different time frames. Look at daily charts, weekly charts. You could even call up like 60-minute charts or monthly charts, like lots of examples. But the ones that really fascinate me, they're the what I call the medium-term trends. So these are the ones that could run for, say, 1 or 2 years. And you just think about it, call up a stock chart and look for a stock that's gone from, say, $1 to $3 or $4 or something like that. And you see this big sweeping move, this big sweeping uptrend. And so that's the sort of trend which I'm focusing on. And I'll look at these moves and I'll ask myself, I'll say, look, okay, there it is. How do I now get it? How do I capture a big chunk of that move? What are the characteristics? The characteristics of the trending phase? What do I need to do to get on, and then actually to stay on? Because that's a key part of making the money. It's not just identifying where to get in, but like, how do I actually stay in and benefit from a potentially a 100%, 200% or more advance? And so that's what I'm building my process around. That's the whole, the basis of the process which I operate under. And my approach really comes down to 5 core principles. And so the first one is trading with the trend. So I want to buy things which are going up. I'm not trying to pick lows. I'm not looking for bombed out stocks which are falling, trying to get a bargain. I'm looking at stocks which are rising, which are working. So I'm happy to buy a stock at a high with the potential of selling it at an even higher high. So that's the trade with the trend part. And then there's the second principle is spreading risk. So it's not just about 1 or 2 big bets. It's about having that wide portfolio, a lot of stocks, and because we never know which stock's going to give us the biggest trend. So we want that diversified portfolio. Principle 3, cutting losses. You don't want a small problem to become a big problem, so you take relatively small losses early on. Principle 4, let your winners run. And really interesting thing, I think we can talk a little bit more about later, but it's a thing which a lot of people don't really get the potential from, because they kind of short circuit the letting profits run part. And then principle 5 is giving your winners room to move around, because stocks don't move in a linear, neat, clean upward line. It's like there's all this movement along the way. And then each principle is going to have all the rules, the rules within the principles, which then govern the whole thing. And this is what really creates I'd call my standard operating procedure for each trade.
Yeah, I
And
love that, because you've got a system that covers those principles. Now, Chris, what are your thoughts about Jason's principles there?
I was just to pick up on Jason's point about trend following. Wealth is not made from noise. People seem to think it is. And traders are very good at taking the signal that market generates for them and turning it into noise and being addicted to that noise. If you can't separate signal from noise and stay with the signal, as Jason said, and just leave things alone, then it's really going to be problematic for you. And part of the issue is we're stuck with this, let's call it a Christian work ethic, this notion that if I'm paid $10 an hour and I work 10 hours, I make $100. If I work 20 hours, I make 200. People automatically apply this to trading, and they go, well, if I do 10 trades and make X, I'll make 10 times X if I do 100 trades. And that's not how it works. If we look at the results, for example, of our recent boardroom group, the vast majority of their wealth for the past year has come from a single trade. And we both know what trade that is, but it's come from that trade. And that ability, as Jason says, just to sit with it, size it appropriately, and just leave it alone. Let it do its thing.
So that's after you're into the trade. But then, Jason, how do you identify that trade? How do you identify the trend and capitalize on that?
yeah, I think the most effective strategies for identifying trends, they're really nothing new. And I think the best bit about this is that they're actually quite straightforward. So for me, it's all about moving averages and breakouts, like stocks breaking to new highs. So it's actually quite simple, and I think that surprises a lot of people, because a lot of people have this notion that complexity is better, that you've got to have an array of indicators and all sorts of rules and filters and maybe fundamental inputs, all these things coming together. And it's interesting. I sometimes look at these some of these YouTubers who are doing videos on the markets, and on their screen I've seen some people with like 6 moving averages. They'll put some Fibonacci levels up, but they won't use the traditional 3 Fibonacci points, which are commonly used. They might have an extra 5 or 6 going as well, and then they'll draw some lines on some on seemingly random points which don't mean a lot. I'm looking at this going, how do you make a decision? Because every time the price moves, it's going to touch a line somewhere. So it's like, this is the thing with complexity. It's like, take the complexity out, keep the whole thing simple. You don't need a whole lot of things going on. You look at the any trading platform, there are hundreds of indicators you could choose from. And look, there's some really good indicators, but you don't need to use all of them at the same time. So it just comes back to me keeping it simple, and simple's often robust, because there's less things that can go wrong. And we want a process that's going to work in real time, not just in the lab, so to speak, or in a couple of hypothetical examples. And so for me, it's about the 50 and 100-day exponential moving averages. So I use a crossover system for those, and using a 70-day breakout high. So really simple, really clear cut. Nothing magic about those numbers. Could use a 10 and 20-day moving average crossover. It's just going to be more active. It's going to give more signals. There'll be more false signals in there. That can be okay as well. That can be managed, but it's more active. I prefer that medium-term time frame, and I think the parameters I'm using are good for doing that. And you just think about, like, say you go to a website like Market Index, and you get up the ASX 300, and you can look at the percentage gain over the last 12 months. So then you sort it by potential, by the gain over the last 12 months. So we'll order it from highest to lowest. Look at the top 10 or 20 stocks, see what they have in common, and you'll find they all have been rising above the 50 and 100-day moving averages. They've all hit a series of new 70-day highs. So they've got that same binding characteristic. So using these indicators doesn't mean you're going to nail all 20 of them, but it's going to put them in your path. It's going to put them in your field of view. And then on the downside, you look at the worst performers and you'll find, well, they've all been trending below their moving averages. So you can quickly and easily just shunt a whole lot of stocks off to the don't look at basket, and you avoid a lot of the undesirables, which cause so much havoc to so many portfolios. And that's what it's about. We're trying to use indicators that can stack the deck in our favour, and then build a portfolio around those ones with the right characteristics.
Yeah, I'm liking that. Chris, what are the similarities between Jason's approach to the markets and your approach to the markets?
I think Jason's point of there is nothing new under the sun is well made. And there is nothing new. There is price and iterations of price. For example, I have in the background open here, TradingView, the web-based platform. The last time I counted the number of downloadable scripts for TradingView, it was about 7,500. Guess what they do? They take price and they mangle it in some way, and they present it, as Jason said, in this immensely complex and convoluted way that is supposed to be helpful and is clearly not. If you speak to any engineer who is designing a machine, you say, what do you do? Well, I try and make it as simple as possible. Why? Because they will always invent a better idiot who will break it and stuff it up. So the more simple you can make it, the better it is. And as Jason said, there is nothing new, nothing new at all. And if you do, as Jason said, and you look at any league table of stocks and you pick the commonality, you will see one thing, a trend up. Well, all right, how do we define the trend? Well, you can use a trend line, you can use a moving average. Your job's done. But the problem is we believe that because trading is presented as this great mysterious thing, that it should be immensely convoluted and difficult. And I sometimes don't know whether that is not an ego-based decision.
Yeah, I'm sure it is. In a lot of cases, people think the more complicated, the smarter they are. Let's tweak out some of the differences between your two systems, though. Jason, I'd really like to hear your thoughts about time stops. Now, this is always a controversial area. A time stop is where you decide in advance that you've been in a trade for long enough at this point, and then you will exit. Now, I'd love to hear your thoughts about that, Jason.
Yeah, it's an interesting concept, the time stops, and it's something that I came up with during when I was backtesting. So backtesting, for those who don't know, it's where we get a set of rules, and then we get a whole lot of data, and we apply those rules to past data. So I get 30 years worth of stock market history, and my rules are programmed into an algorithmic platform, so it's then quite straightforward to go back and apply those rules over the last 30 years. And what I want to see those rules applied to thousands of stocks over several market cycles. I don't want to look at just the last 12 months and a handful of stocks, because there's a fair bit of randomness can come into that. So that's why you want multiple cycles, lots and lots of trades. So that's backtesting. And what I'll do when I get a back test, I'll often go through and I just look at lots of trades, and I'm I'm seeing whether there's any sort of pattern which is showing up in the winning trades and losing trades that could maybe lead to a new idea. And one of the things I noticed was that I was noticing a decent number of stocks which would trigger a signal and then just stall and meander sideways for month after month, maybe a year or longer. And they wouldn't fall enough to trigger the exit stop, and they wouldn't rally. They'd just track sideways. And I thought, well, if you've got a few of those in your portfolio, would you be better off moving them on and bringing in new opportunities? So this is the great thing about backtesting. You can then go and test that idea. Is there any merit to it? And so I did that, tested all sorts of parameters from maybe 10 days to 100 days or more. I can't remember all the parameters, but I ended up settling on 60 days. So 60 trading days are about 3 months. So if a stock wasn't profitable after 3 months, back test would sell it, and it would take on the next signal, and that produced a positive outcome. It increased profitability for a portfolio of limited capital. So if you got unlimited capital, well, you don't need it. But that doesn't apply to anyone. That's we've all got limited capital. So it was. And this is how I trade my personal portfolio. So I'll move stocks on after 60 days, bring in a new one. Now, sometimes a stock will then rally after I've sold it, and so be it, that will happen. But overall, it's producing that benefit of being able to rotate capital more efficiently into new ideas. There are a couple of side effects which come with the time exit, which don't work for everyone. So this is why I don't have it as a standard exit in my motion trader service. That will use the more typical trailing stop loss to exit stocks, and not use a time stop. And that's because a time stop will generate more trades because you got more exits, and not necessarily an issue. But if you've only got a small portfolio and you're doing $1,000 trades, your brokerage bill can add up. If you're doing larger trades, you can typically trade for about $10 a buy or sell now, so it's not that expensive. But smaller parcels, it can add up. And the other issue, well, it's not really an issue, but the other side effect is a lower win rate. And so for me, I don't care. It's not one of the metrics I follow. I'm aware of it, but I'm following the portfolio's value, not the win rate. But win rates are a funny thing because it's a real psychological issue for a lot of people, because a lot of people like that positive reinforcement of a win. And if their win rate drops, they then lose confidence in their process and go, oh, my process isn't working. I think there's so much marketing around strike rates or win rates. I'll see things saying, oh, we've got a 90% success rate. And I can concoct a 90% success rate in 5 minutes of back testing. I just set a take profit at 2%, and I'll have a great strike rate, but the profitability will be woeful because I'll have a huge pile of losses. That's another story. But this is the thing with people getting hung up on win rates. So that's why time exit can be a little bit emotionally challenging for some people, but for others who look at their profitability or their portfolio's value, it's not such an issue, and it's an efficient way to move out of a stock which isn't following through with this upward momentum.
And even if you don't have a time stop as a listener of this podcast, listen to what Jason is saying. He's still working to a formulated plan, something specific, something pre-thought through and documented. Jason, tell us a story about one of your trend trading traders. We'd love to hear what sort of lessons can we glean from other people's experience?
Yeah, I think back to one of my earliest influences, and it was a guy called Richard Dennis. So he was a famed Chicago floor trader in the 1970s. And then he moved up into the office, and he became one of the trend following icons of the 1980s and into the 1990s. And to give some perspective around him, I think it was 1986. In 1986, he made something like $80 million. And at the time, that was on the global stage. That made him one of the greatest traders of that time. And so the story I want to tell you about, it goes back to 1983. So his partner at the time was a guy called Bill Eckhart, and they were having this philosophical discussion about, is a trader born, or can you teach somebody to be a successful trader? And Richard Dennis, he said, look, we can teach people. You can teach people how to be successful. And Eckhart said, look, no, it's an innate ability. You're either born with it or you're not. And so they said, look, let's have an experiment. And they put an ad in the Wall Street Journal for trainee traders, and they got thousands of applications. They took on 14 people, and they called this group the Turtles. And they were named after, Dennis had seen these turtle farms in Singapore. And he said, look, we can train traders, like the Singaporeans are producing turtles, so hence the name. And they got this eclectic group. It was like there was a blackjack player, there was a security guard, a Dungeons and Dragons expert, a few people with some sort of financial background, maybe some accounting or a little bit of trading, but not much. So the thing that bound them together was they all seemed to like games of chance. And so what happened? They get them all together. They've got an intensive period of training. It was I think it was about 2 weeks, and they learned all the trading rules. So it's rules based. It's trend following and it's rules based. So if you get it's really a breakout strategy. If you get a breakout, you buy, and this is when you add, and this is when you cut, and this is when you let profits run, and so on. Pretty much around those core principles I was talking about earlier. And then Dennis seeded them with capital. He gave them up to $2 million each of his money to do this experiment. And so one of the turtles years later said that the group made something like $175 million over 5 years. So from that standpoint, it was this great success. And thing is, only around, it said only about 5 of those original 14 really went on to have big ongoing successful careers. Now, I think there are some interesting lessons from this. And what stands out to me more than anything else is that it shows that absolutely anyone can identify a profitable trading opportunity if they know how to. So it's not a genetic gift. You can be taught. You can be taught to identify those opportunities. And so I think that's really exciting. It's exciting that it can be done, that it's entirely achievable. But it's also a case of like, why is it only 5 or so of the 14? What happened to the other the rest of the traders, like the other 9 or 10 or whatever it might have been? Why didn't they kick on? And it largely came down to the fact that not everyone could follow the rules. So they were given the rules of a successful process, but not everyone could follow them. So successful trading, it's also mental. There's also a mental side to it, which I know you're well across, Louise. And this is something I try to teach people. It's not just about giving people a signal, so buy their stock. A signal is great, but it's only great as long as the market conditions are suitable and everything's going well. Unless you understand the mental side and the process, and it can become really difficult. So you need a robust process, but you also need the right mindset to follow it. So I first heard this story back in 1993, and it was, back then it was the realm of whispers and rumours, but it really got my interest in trend following. And another really interesting takeaway from it was Dennis said he could publish his rules in the newspaper and nobody would follow them. And I found that really interesting, because sometimes I have people, they say, look, if you're so clever and you know this great process, why are you telling me? Why aren't you keeping it a secret? And it goes back to what Dennis said. It said, like, he could publish the rules, people wouldn't follow them, and that's because they don't work trade in, trade out all the time, every day, and it's not this secret formula for making money. And
yeah, absolutely. I do think what you're saying there's a lot to be said for getting those rules to the point where you are sure you can trade them, because emotionally you can take them on. I know with motiontrader.com.au, your company, from everything you're talking about here, you've looked at trade initiation, you've looked at how to exit, both with the trailing stop and possibly with the time stop. And you've looked at risk minimization techniques. But when do you break your rules, Jason?
Yeah, look, I think look, in all successful trading is hard, and I think a lot of people struggle to hear that, because a lot of people are sold the mirage that it's about easy and ongoing and a quick path to riches. But I think the thing people need to bear in mind is that it's actually difficult. And it's the fluctuations in the equity curve that I think people find so hard to tolerate. And I think you've got to stick to your rules as best you can. Sometimes I will break my rules. any system follower should be able to say, ideally, look, 100% of the time I follow the rules, but it can be emotionally challenging at times. So when I break a rule, it's often around being uncomfortable around risk. So rather than a full position, I might take a half position. But it's important, I think, not to stray too far from the path. And that's because a good set of rules are really your pathway to success. That's what your whole process is built upon. And they contain all those good habits. All the good habits that you should do will be contained in a good set of rules. And they also help remove those destructive habits that can really like interfere with your pathway to doing well. I think one way to think about like why it's so important to follow the rules is that they're really a bit like a firewall, an emotional firewall, in that if you follow your rules as well as getting the entry and exit process consistent, they're also helping you dampen those emotions, which can be so destructive. And sticking to that process is a big part of finding that overall success.
And Chris, what about in your own trading? When do you tend to break your rules?
Mine tend to be around the notion of, if there is something occurring I don't understand or I consider to be an outlier event, then I will pull the pin. Simply because sometimes events occur that are outside the domain of the system and one's experience. And it's always worthwhile being able to recognize when that is. I think one of the problems traders have is that they think that if they leave the market at any particular time, then in that interregnum when they're not there, the positions they would have had would have gone from $1 to $1,500. They'll then shut the market will never open again, and they'll never be able to trade. And that is, we come back to that notion of people being egotistical and thinking that the market actually knows they're there and that they actually play some important role. But if something occurs that I don't understand, I will leave. But more importantly, if something is occurring within me that disrupts my rhythm and tone, then I will leave. The market will be there when I get back. Its existence is not dependent upon me.
Jason, I could talk with you all day, and we have to have you back on the show another time because we are running out of time today. But have you got any parting words for our traders? Because you have just got so many good pieces of advice, and I'm sure just to top off that interview, this would be fantastic for people to hear.
Oh, look, I think trying to get over the need for ongoing positive feedback in terms of getting wins all the time. It's important to remember losses are part of the process, and not enough focus is given to losses. People, they think of like placing a trade and they'll think about, look, what can I make from this? But I think it's important to start with, what could I lose from this? And positive feedback is, I think, a reason why a lot of people will take small profits. They'll get a 20% gain and they'll think, look, this is great. I'm up 20%. I don't want to risk that going back to break even, so I'm going to cash out. And this is a real problem. This is why I think so many people can never really break free of being mediocre to a loss-making trader because of these small profits and this need for positive feedback. I think if you're going to be successful, you have to accept that modest profits will come back sometimes and become losses, and that a 50% gain could come back and be a 20% gain. This is the price of staying on trends which could run multiple hundreds of percent. It's this need to protect open equity at all cost, which makes it almost impossible for people to get ahead. So you think about a stock that runs from $1 to $3. It's how many pullbacks would have that had along the way between, say, 10 and 25, or maybe 10 and 30%? It's probably had several. And most people, well, a lot of people can't see off a 10% pullback without getting twitchy and going, well, I better shut this down. So it makes it all but impossible to get those big gains. So I think it's a case of, get good at doing what's right, what you should do, not doing what feels right, and that can unlock like a huge amount of success. And members of my service have said to me that it's like understanding that process of letting trades have room to move and run, which just changed everything for me, because it's this being so protective of modest profits. It's like they end up with the losses cancel out their small profits, and nothing exciting happens. It's those outliers that you can get when you allow them room to move, that they're the ones that create the outperforming portfolios from those that just muddle through at best.
Absolutely. Now, Jason, you have very kindly and generously organised for a free course for all of the Talking Trading listeners, and that is available at motiontrader.com.au/talking trading. What will people find in that course?
Well, look, it's a 2-week immersion into what I do. So they see the sort of the entry and exit process that I use. I explain the process. I go through those core principles. So a big part of what I do, it's not just giving the signals and the exit levels, but it's also explaining the process. Because the people who do best or tend to do best out of what I do, they're the ones who understand the process. And I think, look, what I do doesn't work for a lot of people, because a lot of people don't want to. They don't want to see any losses. But as I say, losses are part of the process. So that's why I'm so open about explaining the process, because I know that to do well, you have to understand the process. And once you do that, you understand that markets move in cycles, they move in trends. Then you start becoming comfortable with saying, look, okay, I understand how a trend works, how I can benefit from a trend, how I can manage my risk around a trend, because a trend won't last forever and not all trends kick on. So it's a big part of the education of what I do, as well, of course, as providing those all-important scans which identify stocks from across the 2,000 odd ASX listings. And look, my favourite part of the day is looking at some of those names I've never heard of before, and that's where where a lot of these emerging stars you see in the ASX 300 in particular tend to come from.
I love it. Jason and Chris, it has been fantastic having you on Talking Trading. Jason, you are a trading celebrity, and I'm just so proud that you're my friend. It is just lovely to chat with you about the markets and to hear how your mind works. And Christopher, you have known me for over half my life. You are my business partner on tradinggame.com.au, and we have been running our mentor program together for the last 24 years. Oh my gosh. So, and it feels that way, he says. So fantastic having you on the show. Thank you so much for sharing your views.
Oh, look, it's been fun. Fun talking to you both. Really enjoyed being a part of it all. Thank you.
Thanks, Louise.
Happy trading, and I'll talk to you next week.